Peter Lynch is one of the greatest investors of all time, and for those of you who don't know who he was a fund manager from 1977 to 1990, where over this 13-year period he outperformed the S&P 500 11 times. His average annual return was 29%, and he turned $18 million into over $14 billion during this period. And one of his favorite metrics to use while investing is one he actually made, and this is called the PEG ratio, also known as the price to earnings to growth ratio. So how you find it is you essentially take the PE ratio of a company and then divide it by its earnings growth rate. So let's say a company has a PE ratio of 15 and it's growing its earnings by 15%. So 15 divided by 15 and we get a PEG ratio of 1. Peter Lynch essentially said that if a company is trading at a PEG ratio of 1, it is fairly valued. If it's under than 1, then it's undervalued, and if it's greater than 1, it is overvalued. Now this can't be used for all companies, but it can be helpful for growth companies, because a company that's trading at 50 times earnings may look extremely expensive, but when looking at its growth rate, it may not be.